Okay, I think we're live. Should we give it a couple of minutes to kind of let people come in and then we'll kick off.
Sounds good.
Perfect. Okay, let's get going. Thank you to everyone who's joined us today. I'm super excited to have this conversation with the finance leaders at the helm of two of the fastest growing scale-ups in the US, Ramp and Vanta. Today, we're going to dig deeper into how the current environment has made them think differently about managing cash, short-term profitability versus investing in long-term growth. Their tips and tricks for cutting spend efficiently without compromising on growth. And hopefully, we can take a little bit of a look inside and get some tips and tricks from them, think about the way that they think, and the key financial metrics that they're really focused on right now. Needless to say, kind of for any CEO or finance leader out there, I'm sure the advice and kind of insight is going to be really, really valuable. So your companies don't need too much introduction, but I think it'd be great to maybe start with you, each of you sort of telling everybody a little bit more about the businesses and also kind of how you got into these roles. So it'd be great to get a bit of your background as well. Alex, do you want to kick us off?
Yeah, absolutely. Well, first of all, thank you so much for having me, and it's good to participate in the event, and we can chat about a topic that's very near and dear to I think all of us. So I'm looking forward to the next little bit. But quick introduction. I represent Ramp. Ramp is a finance automation and expense management company. We're based in New York City, and we've been around for about 4.5 to 5 years. We're roughly at 700 employees or so. And so over the last couple of years, we've definitely experienced quite a bit of growth and whatnot. And our business is really predicated on serving SMBs, mid-market, and enterprise companies and help them manage and automate their finance back office, whether it's expense management, issuing corporate cards, T&E, accounts payables management, as well as accounting integrations. I mean, I won't spend too long on the product suite. There's a lot there. But yeah, we basically, our mission is really to save time and save money for CFOs and finance teams. And my role here is also, very, very special as well, because I work in finance on the finance team at a company that is geared toward finance team. So I think that that's always kind of fun and very ironic. But I've been here for about 3.5 years. I was the first finance hire, and over the last couple of years, it's been a tremendous experience growing the finance team from myself to now we have about 22 people on the finance team overall. And I'll stop there, but obviously happy to go into a little bit more detail just around growing the team and how we fared over the last couple of years. I'll hand it off to David.
I think we should definitely go there at some point in the conversation. It'd be really interesting to hear how you've structured that team. Over to you, David.
Yeah, awesome. First and foremost, Riya, thank you for having me on the call today. And Alex, I've been a big fan of yours for a long time, so I'm honored to be on the panel with you. I'm David Eckstein. I'm the CFO at Vanta. I've been at Vanta now for about a year. It's been probably the most exciting year of my professional career. Vanta is the leader in automated compliance, and we've moved aggressively into additional TAMs. So think GRC, vendor risk management, trust centers. We've quickly become the leader in trust centers through our acquisition of TrustPage. Similar to Alex and Ramp, Vanta is approaching 5 years of existence now and has achieved great results. We are crossing the 425 employee milestone. Expectations are to finish this upcoming fiscal year at 600 employees. And so we've really leaned in. There's a lot of controlled focus, controlled growth. And we've tried to make the most of this macroeconomic downturn. And thankfully, there are a lot of tailwinds which have benefited us in the security sector. And so making a lot of calculated decisions to continue to fuel our growth in 2024 and beyond.
Thank you. And what was your journey into Vanta? Maybe you can kind of tell us a bit about what you were doing before.
So I'm going to go way back for a second. When I was 19, I was the victim of identity theft, and I experienced firsthand how unfortunate, how challenging it is when someone takes your profile and then does nefarious things with it. And to this day, if you look at a credit report for me, even though I'm David N. Eckstein, you will see a David C. Eckstein in Buffalo, New York. And so it lives on many years later. After helping Box raise money and eventually go public, I had the opportunity to join OpenDNS as the first finance hire. It was a really exciting company that I thought was very similar to Box in its potential. And so I joined as the head of finance. We scaled that and sold it to Cisco for $2/3 billion. I stayed on to run cloud security finance at Cisco for 2.5 years. And then I jumped over to another startup, Menlo Security, which was doing a single-digit million ARR at the time. And 5 years later, it had grown quite nicely, roughly tenfold, and is doing very well on its independent journey. So I was the CFO there for 5 years. And then when I heard about the opportunity with Vanta, I'd been an admirer of Vanta for many years. We had used it. I knew other CFOs who had used it. And similar to RAM, it speeds up the time to achieve business results. It is a money saver in many ways because you're getting rid of complicated legacy processes and replacing it with API-driven connectivity. And so as a CFO, I understood the value proposition, and it brought me into additional categories and industries that we weren't in before. So I can now sell to the healthcare space by getting HIPAA compliant. I could go sell internationally by getting GDPR compliant. I could go sell to the federal space by getting FedRAMP compliant. And so it made sense for me as a CFO. It's a product that I would buy. And so I jumped in about a year ago.
Awesome. And very quickly, I'm Riya Grover, the CEO and founder at Sequence. We're moderating this discussion today, so I really want to focus on you hearing from both David and Alex. But very quickly, kind of Sequence helps B2B companies to automate their quote to revenue process. So we have pricing and billing infrastructure that primarily helps companies with usage-based pricing models and custom deal terms to streamline their revenue processes and build a lot more visibility and automation into their finance function and into their business. So Alex, it's interesting. You're obviously trying to help businesses optimize on the spend side of things, and we're trying to do that on the revenue side. My experience comes from having built a business before this, faced this problem kind of directly, and then thinking, well, there's probably some other businesses out there that have as well, and it turns out there's a lot. So let's kick off. I guess maybe I'll start with a sort of, kind of key topic today. And I don't think this is like truly a kind of paradox. So I'm excited to hear kind of how we talk around this. But, there's this sort of framing you'll often hear, which is, are you investing for kind of growth or profitability? Are you trying to sort of manage cash or optimizing for growth right now? And it's interesting because obviously both of your businesses have grown a lot over the last couple of years. You talked about some tailwinds, and it sounds like, David, you've also expanded your product lines quite aggressively. But yeah, would love to hear how you've changed your mindset around sort of cutting burn versus growth versus profitability in the last year in this current environment.
Yeah, I'm happy to go first. So I think that in this environment, if you hit the brakes, it's hard to press back on the accelerator. And so we try to be extremely thoughtful on what does it mean in this macroeconomic environment to invest in your business. And so it comes down to data. We analyze everything. We have a high velocity, large transaction volume business. We're adding many, many hundreds of new customers every single quarter. And so there's a lot of data to analyze. And so we break it down into every part of the Salesforce stage funnel. We're looking constantly at our CACs to understand what's our cost across various marketing channels. And we try to really funnel money into the things that are working for us. We pull back on things that aren't working. Like one example of this is we realized that LinkedIn advertising was just not working. We were spending tens of thousands of dollars on something to get very few leads. Those leads were not converting. It didn't make sense. And it was a quick analysis. And we've tried to re-experiment with LinkedIn again, trying different things. But at the end of the day, it just didn't work for us. And so in this environment, we really need to get close to the details. We need to understand what is working. And we need to make sure that we continue to invest at a moderate pace. We focus on a number of key ratios that indicate how well we're doing. So one of them is the burn ratio. The burn ratio looks at the overall burn of the company versus the net new ARR. When I joined the company, it was a number in excess of 1. Today, it's a number below 1, which means to me that we are in control of our investment. We're in control of the return that we're getting from our investment. We also look at other typical SaaS metrics like the magic number to understand how our sales and marketing spend is translating to net new ARR to the business. And of course, we have to look at our gross retention, net retention, because it's not enough to just bring in a customer into our business, but we want to make sure that we have a path to expanding. And that ties back to the first thing I said, which is we are maniacally focused on TAM expansion. We are the leader in automated compliance. More than 70% of companies pick Vanta. But it's not enough to just be the leader in one space. In order to be, a multi-generational company with billions and billions of dollars of revenue, we are growing faster than the market itself. And so therefore we have to think of adjacent opportunities outside of our existing market today.
Super interesting. And just I guess to kind of probe a little bit more on that product expansion piece, I imagine a lot of the kind of new products you're launching sort of kind of upselling to existing users. But there's risk there as well, right? There's an R&D period, there's an investment in product that kind of may not necessarily pay off. Like, what are some of the kind of key metrics or things that you're looking on that side of the business too, from your perspective?
Yeah, so we also benefit from the fact that our build time is relatively short. We have a great team. We hired this awesome chief product officer who was the VP of product at GitHub for 5 years. And the time that we take from concept to out in the market is fewer than 6 months. We don't have the typical enterprise build time of spending a year and a half to go build something and then testing the market and then trying to sell it. And then it's a 3-year period before we know if this was a good idea or a bad idea. I would say when it comes to our annual operating plan, and sharing that with the board, it is both a tops down and a bottoms up process. Bottoms up meaning we look at the current run rate of our existing spend and we identify how many additional heads each of the org leaders want. But getting back to your question about metrics, we look at the tops down, which is what do other companies similar to us look like when they were around the same ARR, when they were the same number of years from a potential IPO, or when they were crossing similar ARR milestones. What were they spending on R&D? What were they spending on S&M? What were they spending on G&A as a percent of revenue? And then we use that to create the guardrails for our business. So it's okay to be at the high end of R&D as a percent of revenue if your sales growth also is at the high end. But it's not okay to be at the high end of sales and marketing and be one of the lower growers. And so we try to balance those two things. It's both an art form and a science. But that guardrail is really helpful in kind of setting the stage for where we feel comfortable being as a business.
Where do you get that data out of interest?
So when you're larger, you can look at 44B4s or S1 filings. People usually disclose the 2 or 3 years before they go public, and you can compile that data. If you're a smaller company and you have great relationships with your VCs, often the VCs will have that data for you. And then occasionally you'll see anonymized published reports from some banks that aggregate the data and provide certain subsector spend data that you can use as high-level guardrails.
Great. So much really interesting insight in there. And Alex, and kind of from your perspective, has the approach been similar? How have you guys balanced the need for budget cuts with the desire to invest in growth?
Yeah, so we have been forced to grow up very quickly. I mean, I think the last couple of years has been a little bit of a crucible moment for many companies. So I think we would have gone there naturally anyways, but just with everything that was happening in the markets over the last year or two, clearly the discourse had shifted a little bit, where 2 years ago it was growth focused and top line focused. and then I think the narrative definitely shifted a little bit. From Ram's perspective, we're obviously we're very fortunate, right? We've been able to raise something like $1 billion of equity capital over the last couple of years. From a liquidity perspective and operating budget perspective, we have the luxury of right, as opposed to or, which is always you know um, which is always something that I think most finance teams think about. From our perspective, I think it is understanding. If you think about kind of just almost in investor nomenclature. I mean, I was trained as a hedge fund investor for over a decade. This is kind of how I think about the P&L. So when I think about the P&L, I think about quality of earnings, right? Like if you think about all of the different line items in my cash flow statement or balance sheet or my income statement, I think about quality of earnings, quote unquote. In other words, how predictable are each of these line items, and where can I optimize each of these different line items? If something is super, super predictable, recurring, and if something is negotiated, all right, ex ante, like 5-year contract, there's not a lot I can do to impact that. So I don't necessarily think about it too much. And so I think prioritization is always an interesting exercise. And so for us at Ramp, I think we focus on larger line items, and we also focus on line items that we can control, right, where we can be the masters of our own destiny. And I think it's really served us well over the last couple of years, just in, you can try to optimize for everything. You can try to agonize over forecasting and guidance, et cetera, over all of these different line items. For us, it's really just about, all right, how do we prioritize, as the company is growing triple digits, percents year over year, what can we do to be most impactful as, as a finance team, and as a company. It just so happens that the thing that swings the needle the most, right, is the go-to-market organization, is sales and marketing, is sort of top of funnel, right? And so I would say a lot of the discourse has really been focused on, maybe that organization, where we've really had to beef up marketing analytics and beef up how we think about goal setting. How do we think about measuring quota attainment? How do we make sure that folks don't game the system? And how do we make sure that we, can grow and not, blow up the P&L, so to speak? And so I think there's just a lot of maturation there, which may have been probably, I wouldn't say the singular focus of the company, but one major focus of the company. So yeah, I would echo a lot of the things that David had said about, LTV to CAC, or measuring payback, thinking about the burn number, the burn ratio, right? And just thinking about how effective actually is, your investment into marketing and sales and whatnot. I would say financial maturity and maturity of some of these organizations is definitely the name of the game for us over the last year and a half or 2 years.
I think it's really interesting. Obviously, you're both very well capitalized companies, but I think everybody in this environment has tried to take the opportunity to kind of cut discretionary spend where possible, and operate in the kind of most lean possible way. One of the interesting things, Alex, as you said, is, you obviously are in a finance team at a company that helps companies with spend management, and so you see a lot of data on where finance teams might be pulling back their discretionary or variable spend. I think Fiona from your team shared some really interesting stats with us from the Q3 benchmark report, like on kind of Q3 spending that you guys saw across finance teams. I was just wondering if you wanted to kind of share kind of any of those with the audience today.
Yeah, absolutely. I'd be happy to do that. This is something that we're actually very proud of here at Ramp. We're very much a data first, data driven company. The interesting thing about our company is that we have access to a lot of financial transactions, right? We serve tens of thousands of customers, hundreds of thousands of employees, and we track their spend. So we see very, very granular level, of just how companies are changing behavior over the course of time. On a quarterly basis, we release a report that summarizes this. It's anonymized, it's aggregated, but you can tease through a lot of interesting patterns by industry, by merchant base, by the size of the company, et cetera, et cetera. And so, Riya, thank you for teeing this up. In terms of some of our more recent observations from some of from our more recent report. By the way, anyone can Google this. This is free. It's ungated. You can kind of
Mhm.
just look up the ramp benchmark report. But one of the interesting things I'll maybe speak to a little bit is return to office. That's an interesting pattern that we saw over probably the last 2 to 3 quarters. People are definitely spending more on T&E. So people are making it back into the office, or even if they're remote, they're making the time to go more back into the office for kind of offsites, et cetera, et cetera. And what we see is that budgets for that has increased pretty significantly across different businesses. You can also tease out some interesting patterns, which is, you see a little bit more price inflation at JetBlue. Like literally, we'll see that. Whereas if you look at Alaska or United, you see slightly different patterns with respect to ticket prices and whatnot. Another interesting observation we made, which is very stark, is that over the last year, we've seen that across, in a very statistically significant way, across the universe of RAM customers, we're actually seeing people cut back on SaaS vendors. And so oftentimes you hear about SaaS sprawl, or, oh my God, we have so many different vendors that we use. We're not even sure what they're all for. What we've seen over the last 12 months is a very strong, statistically significant pattern where the number of SaaS vendors has gone on average for one of our customers, from our average, has gone from 21 to 16. That's a pretty drastic reduction. It's like a 30% reduction in the number of SaaS vendors you have. And so we're seeing a lot more disciplined spend. We're seeing a lot more deliberate spend among finance teams. So yeah, I mean, I won't really,
Or do we think maybe there's a wave of emerging SaaS players that help companies consolidate across more functions or more things, as well as probably like a little bit of fat cutting around the edges where you're buying software that you're not really using or getting value out of?
Absolutely. So those are probably the two biggest, impacts we saw from the last couple of quarters. But obviously, if you look through the report, I mean, I think we have a list of, the top 5 or the top 10 of these. All of them are actually quite interesting. So, but I'll stop there. I mean, clearly there's been, a macro trend toward kind of travel back to office. Simultaneous to that, there's been a little bit more pricing and kind of SaaS discipline around corporate spend.
Thank you. And so I think it must be very interesting to kind of see the data that you see. David, I mean, on your side, any kind of cost saving measures that have been effective for the company that you think you managed to implement without kind of having an impact on growth?
So I have the fortunate pleasure of joining a thriving company that had been around for 4 years before I joined. And so there were a lot of things that they were doing right. There were some things that could use some CFO tweaking. And I would say I definitely encountered SaaS sprawl when I joined the company. We had over 150 SaaS tools for our 400-ish employees. And so one of the things that we're really focusing on last year and this year is doing more with the tools that we have. I want to fully utilize those tools before we procure additional tools. And so one of the sayings that we have at Vanta is dollar in, dollar out, meaning if you want another SaaS tool besides some AI tool that everyone's hyping up right now, you need to give me back the same number of dollars that I will use to go procure the next tool. And this ignores additional seat increases. So if you go from 200-person headcount to 300-person headcount, that's already accounted for, that's fine. But if you're trying to buy a new tool like Product Board or Loom or something else, you need to give me something else in return to make up for those dollars. So at the end of the day, our overall SaaS cost should remain relatively similar to the year prior. It also just encourages better utilization of our tools. It's not really a money exercise. It's more of a utilization exercise. The other thing I would say, and I kind of called this out already, is you can't save your way to growth. So our money saving technique is to not hit the brakes. And what that means is analyzing the data, understanding the ROI of every single line item in your income statement, and that your teams are analyzing exactly what Alex said to really reallocate the dollars to the things that are working. So one other thing that I brought to Vanta was this concept of accountability review. So an accountability review is after the budget is set and you have some fixed number of dollars for the year. If somebody has an idea, and it can come from anyone, from an IC to a VP to a COO exec, they basically get in front of the accountability review and they make a recommendation. I think we should hire 10 channel managers. I think we should hire 10 SDRs. and this is why. This is the results that I expect in the first quarter, second quarter, third quarter, fourth quarter. And then we schedule a follow-up meeting after it gets funded, or after some of it gets funded, to basically analyze, is this working? Is this having the exact intended consequences? And so it forces really good understanding of the data. It forces a deeper understanding of the risk and reward. What am I putting up? What am I spending? And what are my anticipated benefits? And most importantly, timing. So we had 6 accountability reviews last year. All 6 got funded to varying degrees, not necessarily the full amount, but to varying degrees. And it just forced a really good conversation in terms of what's working for our business. And some of those accountability reviews have taken on a new life at Vanta. And so we funded entire teams off of those kernels of goodness that we saw in 2023. And then the final thing I would say, so part 3 of your answer, is we hired a procurement leader at Vanta named Jake. We brought him over from one of the procurement companies, vendor, and Jake has been amazing. Jake, is an extension of me, so he handles all negotiations with different vendors. He has a lot of industry knowledge, and he's aligning the company's interests with the financial cost of each of these solutions. And then right before we do a renewal or an upgrade, he measures effectiveness. Did we use all of our seats? Is there a new module that we should be considering instead of buying a brand new SaaS tool, going back to the dollar in, dollar out conversation? So I would encourage every organization to think about a procurement person or a procurement leader or a procurement expert early in their cycle, so that they get that extension and that thinking in terms of, am I really getting the most out of the solutions that I have inside the company?
I really like that. And one of the things I actually think are great about recessions is that you can introduce these new mantras into the company, like dollar in, dollar out, or accountability reviews, and then they stick afterwards, even in good times. And so, I think every CFO, every leader out there should be like leveraging the opportunity right now, to kind of, I guess, change the way of thinking within the company, because I think those good practices can and should remain afterwards. By the way, I will say to everybody listening, please do post questions into the chat, and we'll kind of hopefully build some up, and then I'll definitely leave some time at the end to try and tackle them. So the chat button's on the right hand side, and just kind of throw them in there when things come to you. One question I wanted to ask you is, obviously you build financial forecasts, and different organizations or teams within the company will have, a notion of budget to kind of work with based on those forecasts. How often are you revisiting forecasts? Has that kind of cadence increased over the last year? And do you get pushback from different parts of the organization to say, well, actually, look, we had planned to spend X, or like we've already kind of invested months, implementing something, we can't really pull back from it now. And what do those cycles look like? Alex, maybe I'll start with you. I can see you nodding pretty profusely.
Yeah.
So.
Is it too pithy to just say we revisit it every day? So maybe I'll let the folks here peek under the hood a little bit. So obviously it depends, right? Is the answer. Every year we do construct an annual plan that goes 1 year out, right? I mean, the operating model will go out a few years, but I think we generally try to commit to 1 calendar year. We present it to the board, they approve it, we talk through the plan, and we get cross-functional buy-in from the leadership, from all the varying teams. We are still growing as a business. So what you'll find is that there are varying levels of sophistication and varying levels of teams that buy into the model. But you try to do the best you can, obviously. We present the annual model, and ostensibly what we do is we will evaluate our performance against the model essentially every month. So every month we take the operating model, we roll it forward 1 month, and then we basically do a variance analysis, and we try to figure out where are we doing right, where are we doing wrong. On a quarterly basis, when we have board meetings, we'll present some kind of grid or some spreadsheet in which we say, here's where we are against the plan that we presented to you 3, 6, 9, 12 months ago, et cetera, et cetera. Hopefully there are no large variances, and if there are, hopefully they're in the positive as opposed to in the negative, but you never know, right? And obviously over the course of time, you may have to re-forecast, or if you make a large corporate decision or you pivot in a certain direction, clearly, there are some adjustments that need to be made. I think the trick here is that depending on the team or the organization you look at, some of them actually do revisit and reforecast on a pretty high cadence. Our SDR team, for example, these guys will reforecast and submit guidance to their managers once a week, right? And so as you kind of work through your pipeline and the number, you increase the number of calls or emails or outbound or whatnot, over the course of a week or over the course of a month, like you'll just tell your manager how you're tracking, etc. So that's like an every Friday kind of thing. Mm-hmm. If you think about something like paid social, Twitter ads or LinkedIn ads and whatnot, those are metrics that we track. Actually, we set a goal and then we track our progress against that almost on an intraday basis. So are we paying too many cents per SQL? And if we are, do we need to take down kind of our daily investment, et cetera, et cetera? So these are metrics that we actually track on a daily basis, if not intraday. And if we drift too much around, one thing or another, very much so, or depending on, again, business decisions, we may choose to make investment decisions or change our allocation on a very, very high frequency basis. And so, whereas, maybe on the other end of the spectrum, this is the last point I'll make. On the other end of the spectrum, something like capital market strategy, like how we fund ourselves, how much debt we utilize, how we securitize our assets, stuff like that. You kind of create a plan and you just execute around it. You're probably not going to change that, right, on an intraday or intra-week basis. Those are decisions we make for a whole quarter or even for a whole year, and we more or less stick to it. And so that's sort of on the other end of the spectrum where there's almost going to be no deviations around some of the items on our balance sheet or in our P&L, and the other items we're literally revisiting every single day.
David, anything to add on that front?
It was like a masterclass answer, so I don't really have that much additive to say. I would say we also update our forecast daily. We lock in the annual operating plan that becomes the budget. At board meetings, we always compare ourselves to the original budget, the most up-to-date forecast that we showed at the last board meeting, and the actuals that we reported for the quarter. But things change every day. You hire people above your cost expectation, you delay hiring, you bring up hiring, like all of that has an impact on your financial model. And so you have to update that model each and every day.
And we actually just got a question from Adam, which might be interesting to pick up. So Adam, you're asking, do you have specific recommendations to SMBs in slower growth markets? I work on the finance team for a construction contracting company, about 200 employees, strategies for budgeting operating expenses against revenue projections there.
So thinking about a slower growth market, still SMBs, I imagine that the construction company that you work at still has a very small market share. So I don't think you're capped in terms of your potential. I don't think you're capped in terms of your growth rate, because if you're at a 0.1% market share or 1% market share, because it's extremely diversified or very distributed amongst different entrants, then your growth is still kind of uncapped or unlimited. I would say it just goes back to the basics, which is really understand your CAC, really understand what is working, and then continue to funnel money into those proven investments. It doesn't just have to be a marketing campaign. It could be marketing events. You have the hindsight of multiple years of data. And so really looking at that and forcing your org leaders to present data in that way changes the conversation from, hey, this worked at my prior company, I want to try it out here, to we know last year that sponsoring a booth at RSA created $6 million in pipe, and we ended up doing $2 million of closed won. We spent $500,000 on the experience. That's a 4x ROI. Let's do that again. Or let's think about tweaking things so that maybe we can get a 5x this year by having a larger booth, or doing different give outs. So I would use the historical information that you have to your benefit. And I do think that it's very likely that your growth is still uncapped at these early innings.
So changing gears a little bit, we have about 10 minutes left. I want to touch on a few other topics. One is kind of M&A and how you've thought about this in the last year. There's a kind of phrase, making lemonade out of this economic climate, and new opportunities for M&A, possibly arise faster. Of course, there's also the mantra that you shouldn't just buy a company for the sake of it. It needs to make a lot of sense. But how is your thinking been on this? And interesting to hear if you've actually done any acquisitions over the last year as well.
Maybe I'll start. We do not have an M&A strategy. So just to be upfront, we are busy enough kind of running our own company. We don't have sort of an overarching M&A strategy, first and foremost. We have acquired a number of companies, though, actually, it turns out. Over the last 2.5, 3 years or so, we've acquired 3 companies. That being said, I would say for us, it's much more about talent acquisition than anything else. These were smaller companies with extraordinary human capital and extraordinary teams that were almost very, very self-sufficient. We thought very highly of these teams. We acquired the company, brought in the team, and they subsequently formed their own pod and purpose-built to do one thing and one thing really well, et cetera, et cetera. So we've done that a couple of times. But again, much more just talent acquisition than anything else. So I would definitely not say we have any sort of a corporate, M&A strategy.
So similar and different. I think M&A is the easy part, and I think integration is the hard part. And similar to Alex, we haven't done very large acquisitions because I don't know if we have the muscle yet to integrate something like that effectively. I had the benefit of working at Cisco, and that was a machine. OpenDNS was acquisition number 178 for them. And so they had been through this so many times. They have a very built out playbook. Their diligence lists are in the thousands. And they know exactly how to maintain the stride of the company and accelerate it. They have a timeline to get the PIDs on the Cisco PID list in a certain amount of time. Like, it's a very well-run machine. At any startup, it doesn't have to be Vanta or Ramp or anything else. It takes a lot of muscle to get that right. With that being said, we do have a corporate development team. It's 2 people. We are finding right now that there is great tech and talent becoming available. We're noticing, or what I'm reading, is that VCs are basically funneling additional money into the top 10% of their portfolio, and 90% of their portfolio has to just figure the rest out on their own. And so that means that a lot of them will turn towards the M&A market for that outcome. And so Vanta, just given where it is, it's sitting at the center of this automated compliance journey with the potential to move in a number of different directions. We do see both in-house building and acquisition as both viable paths. For us, it would be taking really great tech and talent and integrating it, letting them operate in the way that Alex described, let them create their own unit and continue to thrive, and give them additional resources to go do that with the Vanta engine underneath them. And we're seeing discounts from prior preferred valuations of anywhere from 20 to 90%. So if you do have extra capital and you do have a strategy and those technologies fit into that strategy, this could be a great time to press the accelerator button on your long-term TAM expansion.
As you say, Alex, I think there's this amazing talent out there, some really, really smart teams who are maybe undercapitalized and can't compete and can't raise further capital.
One more thing, and it's not even a bad thing. If it's an enterprise-focused company, the enterprise deal cycle might be 9 to 12 months. And if they have 6 to 9 months of capital left, they know that they are, working towards this 6-figure opportunity, but they don't have capital to get there. And so those are great opportunities to end up getting acquired, because you can still bring in that meaty customer, but now you have time to go after those opportunities in full.
So I guess both of your companies have some sort of acqui-hired new teams kind of operating within the business. And I guess sort of while we're on the question of team, I'd love to, Alex, you talked a little bit about your 22-person team and the kind of journey you've had building that up. Would love to hear about the makeup of that team, and also has your approach to hiring both within your own team and also kind of across the organization. Like, how has that changed in this environment?
I love this question. I love this question because It has, right? It certainly has changed a lot over time. Our company, we've really benefited from blitzscaling, hypergrowth, whatever this the terminology you want to use. And so hiring is always constantly at the forefront of what we do. As a manager, I think, I'm just kind of making up a statistic, but I think if you're a manager at Ramp, you're probably spending 50% of your time in interviews, which is insane. It's almost an insane metric because you're only spending 50% of your time doing your actual job, right? So so the finance team was one when I joined, and now it's 22 people. So the general composition is 50% strategic finance,
Mm-hmm.
and they manage sort of FP&A, operating budget, planning, forecasting, etc., working internally, cross-functionally with various leaders to get buy-in on initiatives. They do a really good job of providing guidance, et cetera, et cetera. The other 50% of my team is what we call core finance, which is kind of a weird nomenclature, but really it's accounting, payroll, procurement, corporate treasury, and capital markets. This is a little bit more outward facing if you think about it, because it's more what is our interaction with our payment processors, banks, lenders, investors, auditors. And so these folks will spend a little bit more time being kind of the external facing, arm of the team. And then so within that team, I would say, by far the biggest portion of core finance is accounting. It's just, a little bit more operationally intensive, it requires a little bit more people. So it's about, I would say, 7 or 8 Stratfin, 5 or 6 accounting. And this year, for what it's worth, we're going to be adding to that team quite aggressively. And then the rest of the team, which is maybe another 4 or 5, is capital markets, payroll, treasury, et cetera, portfolio and risk finance and whatnot. To answer your second question, which I think is super, super interesting, when I made kind of my first couple of hires onto the team very early on, and we're only a 50-person company, or 70 or 100. I really optimized for strong generalists, folks who had extremely high throughput, high agency, and who could tackle any problem you threw at them. I think over the course of time, there's 2 things really that I'm noticing myself optimizing more. One, more specialists. I mean, now we're hiring folks who are experts on securitization or revenue recognition or, enterprise SaaS, right? A little bit more well-versed in that. So much more kind of specialist as opposed to generalist. The second thing I found myself optimizing way more for is communication skills. My goodness. We live in a hybrid environment. Folks are all over the country. We have employees in something like 37 different states now at this point. So very strong verbal and written communications is absolutely key. So for us, it's really just about over communicating up, down to your peer group, et cetera, et cetera. So what I found is that folks who are structured thinkers, structured communicators, I think we've placed a little bit more of an emphasis on that kind of in this era than probably before, where, you're only 20, 30 folks in a room. It's going to be pretty easy just to pick up a call, talk to whoever you need to, and you don't necessarily need that level of just documentation rigor and written culture and whatnot. So it has definitely shifted a little bit over the last 3.5 years.
And actually, one kind of follow-on question from that I have, maybe I'll pose this to David. Like, as a CFO, where probably you're kind of, as you say, you're visiting forecasts very, very often, more often than you would maybe in the good times, potentially, making headcount cuts. Like, as a CFO, has your role in communicating to employees at the ground level, or the way in which you do that, changed in the last year? Would love to kind of hear a bit about that.
Absolutely. So we try to give a lot more market context to how Vanta is performing. So we have this thing called the CFO Corner at all hands every single month, where I take 10 to 15 minutes to explain what's going on in the market. For example, 40% of the world's population is going to the polls this year, and 80% of the world's market cap is going to the polls this year. So there's going to be a lot of volatility as those elections either go to the left, the center, or the right, and that has an impact on the overall business. And so what we say at Vanta is be macro aware, but micro focused. Be aware of what's going on with the Fed and if they're raising interest rates or lowering interest rates, because it has a domino effect on all industries. But at the end of the day, if you're making Vanta 1% better, we're doing our jobs and we're going to be just fine. And so we try to give that broader market context so that when they hear that we're moving into a certain market, or we're doubling down a certain market, or we're doubling down on a certain motion, they can kind of put the pieces together as to why we went in that direction. We want to give all Vantans some level of ownership over their own destiny, but also some control over how decisions are made. And that broader market context, I think, gives them the power to make those decisions.
It's really another, David, you're full of these amazing kind of snippets and takeaways, macro aware, but micro focused. I like that too. And we are at time. I just wanted to ask you guys each one 30-second question and try and keep your answer to 30 seconds as well. But what is one contrarian view that you hold?
Alex, do you want to go first?
I need to think a little bit about this, to be honest.
Okay, I'll tell you what. No, go ahead.
Okay.
Go ahead.
No, Riya, tell me yours.
I was going to say we can wrap up and we can circulate it to everybody afterwards.
I'll give you a quick one, which is I think that the rebound is overly simplified. It's different. It means different things for different stage companies, but usually public markets rise or fall 6 months before the private markets. So that means that the private market should be rebounding pretty soon. I think at the end of the day, we had such high valuations and high watermarks set in 2021. I read some stats somewhere that only 1 in 20 companies will surpass their 2021 valuation. I don't want that to be the case, but it could be the case. And if that's the situation, it's going to be very hard for these companies to press the re-accelerator on their growth and then to have a valuation above and beyond that. And so I think at the end of the day, it's very oversimplified. There are 1,200 unicorn companies. Only 150 of them have ARR above 100 million. And so you're going to have this like long tail of zombie corns that are floating around for a while. And market conditions will allow for the entrenched category winners to reaccelerate. But I think the gap between good and bad will continue to widen. So I'm rooting for all companies out there, but I don't think it's a light switch where all of a sudden you flip it from off to on and things just like work again. I think there's going to be a long dimmer on the way up.
Maybe I'll switch gears a little bit. This would be my little snippet, which is 2022 and 2023 were exceptionally tough years. I mean, it was probably the toughest, couple of years of my career. I'm sure David probably echoes that sentiment. I mean, it was rough, right? Because of the markets. I think in those times, it's very easy to become cynical with your investors, your cap table, the markets. It's easy to become very cynical. How much value do they add? And if they're only funding the top 10% of their investments, what about the other 90%? Are they just leaving us by the wayside? My only observation here is just that I think that assume good intent, I would say. Generally people out there, they're trying their hardest, they're trying to do the right thing and whatnot. And what you'll find is that even if a company or an opportunity doesn't pan out, jobs may be short-lived, but careers are very, very long. So I would just say assume good intent and assume that the folks you're interacting with, you're going to be seeing them repeatedly over the arc of your career. And what I would say is, the last 2 years have been exceptionally stressful. They've been very tough. And people may have said certain things or have done certain things, or the way in which they've interacted with you, may have been, good or bad, et cetera, et cetera. But on the whole, I would say people are trying their best. And if you assume good intent, I think, you'll probably come out for the better, kind of on the other end of that. So that's my kind of observation of the last couple of years.
Positive note for us to leave this on.
Yeah.
Thank you both so much for your time. Really, really enjoyed this conversation. And we will circulate it, the video of it, to everybody in case you want to play anything back. But have a good rest of the day and week. And all the best for 2024.
Take care. Bye.
See ya.